is the economics professor at Koç University and a former economist for the Federal Reserve. Joins me now from Istanbul. I guess to use that phrase that economists and market strategists use, if you look at the currency, the risk is on the downside now. Would you agree?
I would, because as you mentioned, the incumbent government has a higher chance to win the elections, and they have a clear preference to maintain the existing policies, which is this unconventional low interest rate policies. And by definition, if you keep interest rates low, demand for your local currency is going to go down, which is going to put pressure on the currency, which is what we are observing in Turkey right now.
And of course, you import a huge amount of inflation and the lower rates. But there must be a logic to why the president and the government follows this policy, which is agreeably, completely contrary to what everybody else does.
The idea is to stimulate growth, and Turkish economy has been running on steroids for quite some time now, because the decline in productivity has been tried to be compensated with low interest rate policies. And each time low interest rate policies led to overheating and inflation itself slowed down the economy. And then we saw another round of rate cuts. So we got into this loop now. And because more structural reforms have been postponed, the government doesn't have anything else but to rely on rate cuts. But it generates inflation. Inflation itself puts further pressure on the currency, and the desired stimulus in the end cannot be achieved.
So how much is Turkey the beneficiary of everybody else doing the hard work around them? All the other countries and the major economies raising rates, squeezing out inflation, getting back to some sort of orthodox economics. Although Turkey's on a frolic of its own, it does benefit from, if you like, trading partners being more resilient.
I would say that if the idea of rate cuts, well, one reason for rate cuts is to keep Turkish lira or Turkish exports more competitive, that's not really helping, because our exports are not really that price sensitive. So unless our major trade partners, which is Europe, grows faster and their income is higher, our export demand for Turkish exports does not really rely on the exchange rate that much. So I would say for the rest of the world, this is going to be an interesting box that's going to go to textbooks most likely about what happens when you deviate from conventional policy. What are the consequences? And we're going to say that when you do that, you are not really going to achieve the desired growth rate, but you're going to end up with more inflation, because Turkish growth rate has been losing momentum despite all these rate cuts. But from our perspective, it's much more than that. From our perspective, it's a significant decline in our standards of living. And depending on the capital controls that might need to be imposed, it could actually change the pattern of life. Because just imagine that if you cannot really buy foreign currency, you cannot even travel abroad at the extreme scenario.
So when does the crunch moment happen? Because these unorthodox policies, including employing a family in government, these unorthodox policies have been around for some time. And the country seems to muddle on. Agreeably, as you say, the people are getting poorer, the standard of living goes down. But when does the crunch happen? When do people say, we're no longer going to buy the bonds, Turkey heads towards a default or a bankruptcy?
I think the critical variable here is going to be the availability of foreign currency reserves, because that's the way the government has been maintaining or controlling the exchange rate despite low interest rates. So at that point, the two key variables are the government's ability to find foreign currency reserves, because we don't print dollars, we are not the Federal Reserve. And so far, they have been borrowing from the rest of the world, at least from certain partners like the Saudi Arabia or United Arab Emirates. And when that doesn't work, or when that is exhausted, then it's going to be the ability to suppress demand for dollars. But then the implication is, are you going to allow for a slowdown in economic growth? Because we have to import intermediate goods in order to export. So by suppressing demand for dollars, you have to slow down, or you have to let go of your growth targets. So if the government is willing to do that, then they can maintain this current regime, unorthodox regime, for a while. And if they don't want to let go of the high growth targets, then I'm afraid the capital controls is going to be the only solution, which would just turn Turkey into a more closed economy. And like I said, for us who live in Turkey, that would have very adverse consequences for our standards of living.
Thank you very much. We'll talk more on this as
My
we
pleasure.
follow through. Very grateful to have you on the program tonight. Thank you.